Welcome to Breaking News to Trading Moves.
Glad to be here.
Today, we are looking at Nike's recent Q1 earnings for fiscal year 2026. We want to go past just the headlines and see what the numbers might suggest for other companies in retail and apparel.
That's the plan. We're trying to read between the lines of Nike's results to figure out who might benefit and who might face some headwinds based on what Nike's seeing.
And you mentioned before we started, there seemed to be a key split in performance.
Yeah, exactly. A real divergence between their different sales channels, plus some clear pressure on their profit margins. That's sort of the core tension in the report.
Okay, let's start right there then. To really understand the market's view, what are the absolute essential figures we need to know from this report?
Sure. So the top line wasn't too alarming. Revenue came in at $11.7 billion, which was up about 1%. And earnings per share, $0.09, actually beat expectations.
Okay, so far so good.
But the issue is how they got there. The wholesale business, selling through other retailers, grew a healthy 7%.
Right.
But Nike's own channels, Nike Direct, actually dropped 4%. And the digital part of that was down even more, 12%.
Wow, okay. A 7% rise in one area and a 12% fall in another. That's quite a gap. What about the margins you mentioned?
Yeah, that was the other flag. Gross margin landed at 42.2%. Now, that's a drop of 320 basis points compared to last year.
320 basis points. And what drove such a decline?
Primarily two things, according to the report. Higher tariffs coming into North America and, well, more discounts and promotions needed to move inventory.
Right. That level of margin drop, 320 points, that feels like more than just a bit of seasonal clearing. Is that indicating some real strategic pressure?
Oh, absolutely. A drop that large says it's not just routine inventory management. It points to, significant headwinds, external ones like the tariffs and internal ones like needing deep discounts. It suggests they really had to mark things down.
Okay, let's unpack the implications then. Starting with the positives, the unexpected areas of strength. That 7% growth in wholesale. Why is that seen as good news for some traditional retailers? Isn't Nike usually focused on selling directly?
Well, yes, they were heavily focused on direct-to-consumer DTC. But this growth suggests maybe a bit of a pivot back, or at least a rebalancing.
Okay.
It indicates potentially better relationships with their retail partners, and crucially, it means more new, exciting products might be flowing into those partners' stores again.
So instead of keeping all the best stuff for Nike.com or their own stores, they're sending more out.
That seems to be the implication, especially it seems with some of the newer running innovations. This helps drive traffic and sales for those key retail partners.
So who benefits most directly from that renewed flow of Nike product?
The analysis points towards the big sporting goods retailers who have strong partnerships with Nike. Think Foot Locker, that's ticker FL, and Dick's Sporting Goods, ticker DKS.
Right, FL and DKS. Makes sense. They need that hot Nike product on their shelves. Now, management also mentioned progress specifically in performance running. That's separate from just everyday sneakers, right?
Correct. This is about shoes designed for actual running.
So when Nike says they're doing well there, how does that help their competitors in the running space? Seems counterintuitive.
It sort of validates the whole category. If Nike is seeing strong demand in performance running, it suggests consumers generally are interested in high-performance gear right now. It signals robust demand across the board, not just for Nike.
Like a rising tide lifting all boats in that specific category?
Sort of, yeah. It suggests the consumer is actively seeking out function and performance, which benefits other brands focused purely on that.
Okay, so which specific brands might get a boost from Nike confirming this trend?
You'd look at the specialty players known for high-end performance. The analysis specifically mentioned Deckers Outdoor, ticker DECK. They own Hoka.
Hoka, right. Very popular.
And on Holding AG, ticker ONON, both are direct beneficiaries if the overall demand for serious running gear is strong.
Okay, DECK and ONON. Now let's swing back to that margin pressure, the 320 basis point drop driven partly by discounts. When a giant like Nike ramps up promotions, who wins?
The off-price channel, almost certainly. When big brands need to clear inventory, whether it's seasonal leftovers or just slow-moving items from their direct channels, that product has to go somewhere.
And the off-price guys are waiting with open arms.
Exactly. They're built for this. They absorb that excess branded apparel and footwear. So companies like TJX companies, ticker TJX, and ROST stores, ticker ROST, tend to do well in these periods.
TJX and ROST.
Got it. Okay, that covers the winners. Now let's look at the other side, the areas showing weakness and the companies potentially facing challenges. That digital performance, Nike Direct down 4% and digital specifically down 12%, seems pretty stark.
It really is.
Why is that such a concerning signal for other brands, especially those built around the DTC model? Because if Nike, with its massive brand power, marketing budget, and loyal customer base, is seeing double-digit declines online, it suggests the overall e-commerce environment for apparel and footwear is pretty tough right now.
Meaning heavy promotions everywhere online.
Very likely. It implies you need significant discounting just to keep sales moving online, and that really hurts brands that rely heavily on DTC.
Because their whole model is based on higher margins from selling direct.
Precisely. The DTC model often involves high costs to acquire customers.
Right.
If you then have to discount aggressively, that erodes the profitability that makes the model work. It's a difficult setup for brands banking on DTC for growth, especially if they lack a strong wholesale backup.
So which brands are potentially vulnerable here, given the signal from Nike?
The analysis flagged names that are quite DTC-centric. Lululemon Athletica, ticker LULU, is one. While they're very successful, they do lean heavily on their own channels.
LULU, okay.
And also Allbirds, ticker BIRD. Their model is almost entirely built on direct sales and maintaining that brand margin.
BIRD, okay, that makes sense. Now, the other factor hitting Nike's margin was tariffs. Nike mentioned higher North America tariffs. If they're feeling the pinch, what does that mean for smaller players?
It's definitely a negative read-through. It signals that these costs are real and hard to avoid. For smaller companies importing apparel and footwear who lack Nike's sheer scale.
They can't negotiate rates as well or easily shift production.
Exactly. Or they may not have the pricing power to just pass those costs onto consumers. So they often end up just having to absorb the tariff costs, which directly squeezes their own margins.
Which companies might be particularly sensitive to these import costs?
You'd look at large apparel importers. The analysis highlighted VF Corporation, ticker VFC. They own brands like Vans and The North Face.
VFC.
And also Columbia Sportswear, ticker COLM. Both rely heavily on imports and could feel that tariff pressure.
COLM. Okay. And the last piece of weakness was Converse, a 27% drop in revenue there. That's dramatic. What does that tell us?
It strongly suggests a pullback in demand for casual and lifestyle footwear. Converse is a classic lifestyle brand, a drop that steep points to consumers perhaps shifting their spending.
Shifting away from casual comfort toward
The performance products we talked about earlier. It looks like people are currently prioritizing items for specific activities over just everyday casual style.
So if that's the trend, any brand focused primarily on lifestyle or casual footwear could be facing a headwind.
That's the implication, yes. When consumer preferences shift like that, brands tilted heavily towards casual or lifestyle feel the impact.
And who falls into that category according to the analysis?
It specifically mentioned Crocs, ticker CROX, and Stephen Madden, ticker SHOO, as potentially exposed to this move away from lifestyle and towards performance.
CROX and SHOO. Okay, so we have a pretty clear map now. Winners seem to be wholesale partners, performance running brands, and off-price retailers. Losers potentially include DTC-heavy brands, tariff-sensitive importers, and lifestyle-focused names.
That's a good summary of the read-throughs.
So, based on the material we reviewed, how might someone use this understanding? What are the potential strategies or angles that come out of this analysis?
Right. The analysis laid out three main potential trading angles based on these dynamics.
Okay, let's hear them. Angle number one.
The first is called the wholesale play. It's fairly straightforward. Basically, maintaining a positive stance, maybe a long position, on those wholesale beneficiaries we mentioned, Foot Locker, FL, and Dick's Sporting Goods, DKS.
As long as that trend of Nike pushing more product through wholesale continues.
Exactly. You're essentially trying to ride that wave of renewed product flow to traditional retail.
Okay, makes sense. What's the second angle? It sounded like it involved that performance versus lifestyle split.
Yes, angle two is about expressing that performance theme. It uses a pair trade structure.
A pair trade, how does that work?
So the idea is to capture that consumer shift without making a big bet on whether the overall stock market goes up or down. You go long on brands with strong performance running exposure like Deckers, DECK, or on holding, ONON.
Right, the performance winners.
And at the same time, you go short on some of the lifestyle tilted peers that seem to be losing out from this shift, like Crocs, CROX, or Stephen Madden, SHOO.
Ah, I see. So you're betting purely on performance outperforming lifestyle, regardless of the broader market direction.
Precisely. It isolates that specific theme, the consumer preference shift.
Clever. Okay, and the third angle?
The third one is termed DTC caution, given the weakness Nike showed in its direct channels.
Especially digital.
Right. The suggestion is to potentially fade or maybe short some of those DTC-heavy names like LU or BIRD, particularly heading into potentially promotional periods if this channel softness persists.
So it's conditional. What's the key thing to watch there?
The analysis stressed monitoring future guidance from these companies very closely, especially anything they say about their expected margins for the next quarter, Q2, and the ongoing impact of tariffs. That guidance will give clues about how deep the promotional pressures might get across the industry.
Got it. So watch Q2 guidance on margins and tariffs for clues on DTC pressure. That really brings it all together.
It seems to.
If I were to try and boil down the main takeaway for our listeners from Nike's Q1, it feels like a real shift from what we saw during the peak pandemic years. Strength is now in wholesale and performance running, while there's clear weakness in digital, direct-to-consumer, and the lifestyle category. And all of this is happening under the shadow of those margin pressures from tariffs and heavy discounting.
That captures the central tension really well. And maybe a final thought for you to ponder after this. We see consumers pivoting to performance gear now, maybe partly driven by discounts, making it more accessible. But what happens to the broader apparel market after this heavy discounting eventually eases? Will performance maintain its lead, or will lifestyle make a comeback?
An excellent question about the longer-term structure. Now, just a quick but important reminder for everyone listening. This entire conversation has been based on analyzing the Nike Q1 earnings report and its potential implications as presented in the material we reviewed. Straight. This is not financial advice. We aren't making buy or sell recommendations on any stocks mentioned. This discussion purely reflects the opinion of the author of the analysis.
Absolutely. Always do your own research.
Okay, I think that's all the time we have for today. Thanks for walking us through that.
My pleasure.
Until next time, on Breaking News to Trading Moves.